In a significant shift in U.S. cryptocurrency regulation, the Department of Justice (DOJ) has announced the disbandment of its National Cryptocurrency Enforcement Team (NCET). This move comes as part of the Trump administration's broader strategy to loosen oversight of digital assets, a policy change that reflects the former president's commitment to transforming the United States into the leading hub for cryptocurrency innovation. Deputy Attorney General Todd Blanche delivered the news in a memo to DOJ staff on April 7, stating, "The Department of Justice is not a digital assets regulator." He criticized the previous Biden administration's approach, which he characterized as a reckless strategy of regulation by prosecution. Blanche emphasized that the DOJ would now focus its resources on prosecuting individuals who defraud digital asset investors or engage in illegal activities associated with cryptocurrencies, such as human trafficking and organized crime. The NCET was established in 2021 during President Biden's tenure with the aim of tackling the misuse of cryptocurrencies for criminal activities. It played a pivotal role in high-profile cases, including investigations into Tornado Cash, a crypto mixer used to obscure the origins of funds, and hacking incidents attributed to North Korean actors. However, under the new directive, Blanche instructed DOJ employees to cease pursuing cases against exchanges and services that facilitate cryptocurrency transactions unless they directly victimize investors. This restructuring follows a series of executive actions taken by Trump since his January inauguration that signal a pro-crypto stance. One notable directive was the establishment of a strategic Bitcoin and digital assets reserve aimed at bolstering the nation's position in the global cryptocurrency market. During a recent meeting with industry leaders, Trump proclaimed, "I promise to make America the Bitcoin superpower of the world and the crypto capital of the planet," underscoring his administration's intent to foster growth in the digital asset sector. While proponents of cryptocurrency welcome this regulatory retreat, critics express concern about the potential risks associated with diminished oversight. Advocates argue that previous enforcement actions disproportionately targeted legitimate businesses, stifling innovation. For instance, Peter Van Valkenburg, executive director of the advocacy group Coin Center, praised Blanche's memo, stating, "We should be going after bad guys, not the developers of good tools that bad guys happen to use." However, this shift raises critical questions about the balance between fostering innovation in the burgeoning cryptocurrency market and ensuring adequate protection for investors and consumers. As the DOJ transitions away from its previous enforcement strategies, it remains to be seen how this will impact the landscape of cryptocurrency regulation in the U.S. and whether the administration will succeed in its ambitions to become a global leader in digital assets. As the crypto industry matures, stakeholders will be closely watching how these policy changes unfold and what implications they may have for the future of digital currencies, investors' safety, and overall market integrity. The ongoing dialogue surrounding regulation will undoubtedly shape the trajectory of the cryptocurrency landscape in the years to come. As the landscape of cryptocurrency continues to evolve, 2025 has emerged as a significant year for both individual investors and major players in the market. A notable trend has been the increasing interest in cloud mining services, particularly those that allow users to generate passive income from the comfort of their homes. Among these, HESminer has garnered attention as a leading platform, enabling users to mine Bitcoin without the need for hefty upfront investments or expensive hardware. HESminer, which has been operational since 2020, offers a straightforward approach to cloud mining. New users can kickstart their mining journey with a $30 bonus upon registration, allowing them to earn approximately $1 in Bitcoin daily without any deposit. The platform provides a variety of flexible contracts starting as short as 1 day, catering to diverse income goals. This accessibility has made it an attractive option for many looking to enter the cryptocurrency space, especially those who may feel overwhelmed by the complexities of traditional mining methods. In addition to its user-friendly interface, HESminer boasts several features that enhance the mining experience. Users can monitor their earnings in real time through a robust mobile application available on both iOS and Android, making it easy to manage accounts on the go. With zero maintenance fees and the absence of electricity costs, users retain 100% of their mining profits, a significant advantage compared to conventional mining setups. Security is another critical aspect of Hexminer's offerings. The platform employs cold wallet storage and two-factor authentication 2FA to safeguard user assets alongside transparent daily mining reports that provide reassurance about the safety and legitimacy of the service. Hexminer's commitment to security and transparency has played a crucial role in establishing its reputation as a reliable mining platform, particularly as the cloud mining sector continues to grow in popularity. However, the broader cryptocurrency market has faced its own challenges, with Bitcoin recently experiencing volatility. On April 8, 2025, Bitcoin's price dropped to around $77,000, down from approximately $80,000 earlier in the day. This decline was attributed to investor apprehension surrounding geopolitical factors, including trade policies and inflation concerns. Major crypto-related stocks also reflected this downturn, with companies like MicroStrategy and Coinbase seeing declines as the market reacted to the uncertainty. In the context of these fluctuations, there is a concerted effort from lawmakers to understand and integrate cryptocurrencies into the fabric of the U.S. economy. Junior Senator Jim Justice of West Virginia recently articulated a vision for Bitcoin's role in restoring America's economic strength. He advocates for the establishment of a strategic Bitcoin reserve, suggesting that Bitcoin could serve as a stabilizing asset akin to gold. This initiative aims not only to harness Bitcoin's potential to reduce national debt but also to position the U.S. as a leader in financial innovation. Justice's perspective reflects a broader trend among policymakers recognizing the need for a regulatory framework that encourages the growth of digital assets while ensuring consumer protection. As discussions around cryptocurrency regulation intensify, the potential for Bitcoin to become a more integral part of the financial landscape in the U.S. appears promising. As 2025 unfolds, the dynamics between cloud mining platforms like Hexminer, market volatility, and regulatory developments will likely shape the future of cryptocurrency. For individuals looking to earn passive income or invest in digital assets, it is crucial to stay informed about these trends and the technologies driving them. With Hexminer and similar platforms making Bitcoin more accessible, the path to participating in the crypto economy has never been clearer. As the industry matures, the potential for innovation and financial inclusion remains vast, inviting both seasoned investors and newcomers to explore the possibilities that lie ahead. In an unexpected twist within the turbulent realm of cryptocurrency, the aftermath of the recent election has sent shockwaves through the market, particularly affecting the assets associated with former President Donald Trump and his administration's policies. As Bitcoin and other cryptocurrencies face significant volatility, the political landscape continues to shape investor sentiment and market dynamics. On April 8, 2025, Bitcoin fell to approximately $77,000, marking a substantial decline from its earlier highs of around $80,000 earlier in the day. This drop reflects a broader trend of uncertainty among investors who are grappling with the implications of Trump's trade policies and tariffs. Notably, the price of Bitcoin has plummeted nearly 17.8% since the start of the year, while Ether, the second largest cryptocurrency, has fared even worse with a staggering 56.23% decline. The Trump administration's recent decision to instruct federal prosecutors to ease their regulatory grip on the cryptocurrency sector adds another layer to this complex narrative. In a memo, Deputy Attorney General Todd Blanche directed that virtual currency exchanges and related services should not be targeted for the unintentional regulatory violations of their users. Instead, the focus will now shift towards individuals committing crimes utilizing digital assets such as terrorism financing and organized crime. This shift has raised eyebrows, particularly in light of the Justice Department's disbandment of its National Cryptocurrency Enforcement Team. A move that some analysts argue undermines the oversight that characterized the previous administration. Investors' reactions to these developments have been mixed. While the Trump administration's policies may provide a sense of relief to some in the crypto community, the broader economic environment, characterized by stubborn inflation and escalating trade tensions, has left many wary of risk assets. As a result, stocks tied to the crypto market such as Coinbase and MicroStrategy have seen declines of 2.25% and 5.77% respectively. Market analysts suggest that the decline in cryptocurrency values is closely linked to the uncertainty surrounding Trump's tariffs, which could significantly impact consumer prices and subsequently market confidence. For instance, experts warn that if tariffs escalate, the price of everyday items, including technology products, could surge, further straining the economy and potentially leading to reduced consumer spending. Amidst this backdrop, Trump's financial ties to the cryptocurrency industry have also come under scrutiny. His administration's policies appear to favor the market, yet the declining prices of major cryptocurrencies indicate that investor confidence is faltering. The sentiment among crypto investors, many of whom supported Trump in the 2024 election, has shifted as they contend with the realities of a tumultuous market. As the situation evolves, industry leaders are keeping a close watch on both regulatory developments and broader economic indicators. The recent policy shifts might signal a more lenient approach towards cryptocurrency regulation, but the volatility in asset prices raises questions about the sustainability of such an environment. Looking ahead, the interplay between political decisions, regulatory frameworks, and market performance will continue to be a pivotal aspect of the cryptocurrency narrative. As investors brace for further fluctuations in this fast-paced and unpredictable sector, in a bold forecast that has captured the attention of the crypto community, Standard Chartered has predicted that XRP could soar to as much as $12.50 by 2028, marking a staggering increase of over 550% from its current trading price of approximately $1.90. This projection, articulated by Jeffrey Kendrick, the bank's global head of digital assets research, posits that XRP's market capitalization will not only surge but could also surpass that of Ethereum, positioning XRP as the second largest digital asset by market cap in a mere 3 years. Currently, XRP's market cap is estimated at over $110 billion, ranking it fourth in the cryptocurrency hierarchy, trailing Bitcoin, Ethereum, and Tether. In Kendrick's analysis, he notes that the market cap of Ethereum stands at around $183 billion, indicating a significant gap that XRP aims to close. By the end of 2028, we see XRP's market cap overtaking Ethereum's, Kendrick remarked, highlighting the seismic shifts expected in the digital asset landscape. The optimistic forecast is bolstered by several factors, including favorable regulatory developments and institutional adoption. A pivotal moment for XRP came with the recent resolution of the lawsuit between Ripple, the company behind XRP, and the U.S. Securities and Exchange Commission (SEC). Ripple CEO Brad Garlinghouse announced that the SEC had dropped its lawsuit, allowing Ripple to settle for $50 million without admitting any wrongdoing. This shift in regulatory sentiment, particularly under the current administration, has raised hopes for a more favorable environment for cryptocurrencies. Kendrick anticipates that the approval of spot XRP exchange-traded funds ETFs could further fuel XRP's price growth, projecting inflows of between $4 billion and $8 billion within the first year of their launch. This aligns with estimates from other financial institutions, including JP Morgan, which have noted the potential for significant market penetration similar to that seen with Bitcoin and Ethereum ETFs. In examining the broader context of XRP's utility, Kendrick emphasizes its cross-border payment capabilities, which align with increasing trends in digital asset adoption. He likens the XRP ledger XRPL to successful blockchains like Stellar, particularly in its potential for tokenization. Kendrick projects that XRP could reach $5.50 by the end of 2025 and $8 in 2026, contingent on Bitcoin reaching $500,000 in the same timeframe. Despite the optimistic outlook, Kendrick does not overlook the challenges XRP faces, including a smaller developer ecosystem compared to its rivals and a low-fee structure that may hinder competitiveness. Yet he remains confident that the positive catalysts outweigh these hurdles. In a contrasting narrative, Ethereum, co-founded by Vitalik Buterin, finds itself in a precarious position. Following a viral moment where Buterin humorously interacted with a robot making a meow sound, Ethereum's price has dipped below the $2,000 mark, prompting speculation about the project's future. Some analysts and traders have expressed concerns regarding leadership and the broader implications for Ethereum as Layer 2 solutions gain traction, potentially diminishing demand for the main Ethereum network. As the crypto landscape continues to evolve, the coming months will be critical for both XRP and Ethereum. With regulatory landscapes shifting and market dynamics in flux, stakeholders will be closely monitoring these developments. The contrasting trajectories of XRP and Ethereum not only reflect the inherent volatility of the digital asset market but also underscore the importance of adaptability and innovation in shaping the future of cryptocurrencies. In a significant development for the decentralized finance DeFi landscape, Janover has successfully raised $42 million to bolster its treasury strategy based on the Solana blockchain. This funding round, which reflects a growing confidence in Solana's capabilities, positions Janover to enhance its operations and expand its offerings within the rapidly evolving crypto ecosystem. Founded with a vision to streamline treasury management for blockchain projects, Janover is set to use the funds to build innovative tools that leverage Solana's high throughput and low transaction costs. The company aims to provide a one-stop solution for managing funds, allowing users to navigate the complexities of treasury management more effectively. In a statement, Janover's CEO commented, "Our aim is to create a seamless experience for projects on Solana, empowering them to maximize their treasury potential while minimizing risks." This fundraising not only highlights the increasing interest in Solana as a platform but also underscores the broader trend of institutional investment in DeFi solutions. Investors are recognizing the potential of Solana to compete with Ethereum, particularly as it continues to garner attention for its speed and efficiency. The $42 million raised will enable Janover to attract top talent and expand its technology stack, further solidifying its position in the sector. As Janover embarks on this ambitious journey, the implications extend beyond just its own operations. The influx of capital into Solana-based projects reflects a renewed optimism in the crypto market, especially following recent market fluctuations that have seen many cryptocurrencies facing downward pressure. Moreover, Solana itself has recently experienced volatility marked by a 7% rally that coincided with a broader market recovery. However, analysts warn that this increase may not be sustainable, as indicators suggest a lack of strong buying momentum. The Chaikin money flow CMF for SOL, currently below zero, indicates that selling pressure could outweigh buying interest, potentially leading to a reversal in the asset's price trajectory. The recent price fluctuations have left many traders cautious, with a noted bearish sentiment prevailing in the market. Should the price of SOL fall below critical support levels, analysts predict a potential decline toward the $79 mark. Conversely, a sustained upward trend supported by new demand could see SOL breach resistance levels and move towards $130. As Janover prepares to innovate within the Solana ecosystem, the strategic developments in both the company and the broader market will be closely watched. The coming months will be crucial as Solana attempts to solidify its place in the DeFi space amidst ongoing market dynamics and competition. Investors and developers alike will be keen to see how Janover's initiatives unfold and whether they can contribute positively to the overall health and growth of the Solana blockchain. In conclusion, Janover's successful fundraising serves as a beacon of potential for Solana's future, signaling that as long as innovative projects continue to emerge, the blockchain's reputation as a viable and competitive platform in the DeFi space will likely remain intact. The interplay between market sentiment and technological advancements will ultimately shape the trajectory of both Solana and its burgeoning projects in the months to come.